Hi, I'm Cody Jernell. I'm the broker and owner here at Haven Management Group. Wanted to congratulate you on downloading this free calculator. It's something that we've put a lot of time into and we've tested over and over again on multifamily properties. So I'm going to dive into a little bit of history, why we created this, how our company works, but then give you the framework that we've used to look at properties and what their current state is and see how we can get them from point A to point B, making more money and sometimes adding over $1 million worth of actual value in the property at the end of our action plan. So, just a little bit of background. We started Haven Management Group because we didn't have what we thought we needed whenever we got started in the investment game. So, I brought acquisitions, which is sales, management, and construction all under one roof. It's been really good for our clients. They've appreciated the fact that they've got one point of contact throughout the whole life cycle of their investor journey. We also do have education resources and things along those lines for investors that are just trying to get in the game or they're trying to scale into other properties. So with that, we've done a lot of multifamily projects. And one of the most important things in a multifamily project is knowing what your current valuation is. So I'm sure you already know this, but residential properties and commercial properties are valued differently. The easiest way to break that down is that multifamily property, which is anything that's 5 units or more, is valued more like a business based on the income that's left over after all your expenses come out. As opposed to residential properties where they go out and look down the street, the house that you live in, your grandma's house, they take comps around the area, see what similar properties have sold for, and that's how they come up with the valuation of that property. Commercial property and multifamily property is based on the income at the end of the day. So it's run and valued more like a business, which is why we love it. And they use a cap rate to spit out the value. So that's what this calculator was built for. Now we centered it around what we call our case framework. And this is really the framework that we use when we're looking to purchase property or we're getting into a multifamily deal where we feel like we can increase the income or add some sort of value. So the first step, and you'll see these tabs in the bottom here, the first step in that case framework is what is the current state of the property. So that's where we come in and we put in all the numbers for our current rent, who's not paying rent, what units are vacant, things along those lines, and all of our current expenses. So once we do that, we will have a chance to see what the current value is. So in order to get from point A to point B, you have to truly understand what your current value is on the property, and that's going to show you what it could be worth after you get to the next step. So C stands for current state of the property. Our A stands for the action steps. So as we go through this process, our company internally does a full-blown audit on every property that we look at. We look at all the rents. We look at how many units are vacant. We see if the rents are at market rate or below market rate. We look at the expenses. We see if there's expenses that the owners are currently taking on that should be a tenant expense or could be a tenant expense. We look at what we're paying our insurance vendors, our trash collectors, everything that affects that income and expense kind of spreadsheet and what the NOI is at the end of the day. So once we kind of have the action plan in place, after we have found the current state, we go into the next tab down here, which is just a duplicate of this spreadsheet. But when you enter the stabilized numbers, you want to use the numbers that you project that you can charge or not get billed for after the action plan has taken place. So if you're getting rents up to market rent, that's where we input these numbers. We put them in the stabilized spreadsheet. If you're lowering expenses by flipping electricity bills over to a tenant paid expense, then you want to reflect that in the stabilized spreadsheet. And that's going to change the value, could be pretty drastically, the current state versus stabilized state. And that's what we really want to see as property owners. So let me run through this. The last piece of that, before I forget, is the execution phase. So obviously, once you figure out where you're at now, what you need to do, what the property is going to look like once it's stabilized, you have to go and execute that game plan. And that's what really our bread and butter is. We've got the people that can do this audit and provide a playbook up front, but we've also got the team that has done this multiple times that can actually execute the game plan. So if you're interested in that, once you get through the spreadsheet, you can definitely reach out to us. Best email is cody@havenpm.us, or you can reach out via phone at 540-599-7480. So I'll kind of shut up on that and we'll get into the spreadsheet. So I have an example here. Notice we are on the current state of the property. So example, let's say this is unit 305. We like to put the bed and bath count in here. And then we're going to input our monthly income, which will spit out an annual income. This whole spreadsheet is formulated already, so you don't necessarily have to change anything. But this could change based on your unit count, or if you have more than one building, you will just copy and paste this at a different part of the spreadsheet and come back in here and add those values into the total income. So let's take this and let's say we've got let's just say this is a 6-unit property. So we've got unit 1, unit 2, unit 3, unit 4, unit 5, unit 6. I can't spell apparently. So, and we'll just call these all 2-bed, 1-baths. I'm going to be making numbers up here, so bear with me a little bit. So let's just say all of our 2-bed units are bringing in, let's say $1,250 a month. Well, since this is current, let's say we're at $950 on some of these. Let's say unit 3 is vacant. Let's say unit 4, we've done a few updates to, but we haven't got quite to market rent. Unit 5, same thing. And then unit 6, we'll say that's vacant as well at the moment. So we've got some upgrades here to do. I don't know your situation, but I'm just, creating a scenario here that we can see what the difference is going to be based on where we're at and where it could go. So let's say this is a typical property. We've got a couple vacancies. All of our units are slightly under market rent. And then, let's say we don't have any additional income sources right now. So I would say identifying someone might be parking or, storage. So no income coming in on those right now, but we'll look at those when we get to the stabilized pro forma. So right now, based on almost $50,000 of total income per year, we take out a management fee. If you're self-managing, then you don't necessarily have to account for that. However, if you're going to a bank at any point in time, they're gonna use a management fee as part of the pro forma on the numbers. So it's always good to just bake that number in, whether you're paying yourself that or not paying it at all, or you have a management company, bake that into that. So vacancy here, we're kind of already counting our vacancy based on the rent. So with this one, we can just assume we're looking at about $5,000 worth of vacancy a year. Accounting, again, you got to run your own numbers here. But let's say my accountant charges $1,000. Insurance on this, let's say $2,700. Licensing and fees, marketing, that should be kind of property management stuff, supplies, taxes. We'll call this a $4,000 tax bill at the end of the year. Repairs and maintenance, if the property's a little behind on the maintenance side, then you could be looking at more or less, but I'm just punching in numbers here for you. Trash services, we'll call $2,500 a year. Utilities, if they're paid by the owner, then you input your number here. If they're all paid by the tenants, then you obviously don't need to input that. If you've got like a common area electric bill, that's where this will go in. So we'll just call it, let's say right now that you're paying the utilities for all of the tenants. Let's see, 6,000. Water and sewer, that's kind of hit or miss. Most of the time, owner's going to have to pay that. Call that 2,000. Internet, we'll just say that the tenants are paying that, so that's good. And then capital expenditure reserves. If you're not putting capital expenditure reserves away, it's probably a good idea. At some point, you're going to have to replace a roof. At some point, you're going to have to replace some HVAC. So depending on what type of shape your major systems are in, you kind of want to figure out, okay, if I'm saving for a $10,000 roof down the road and I feel like I have 10 years to replace it, then I probably want to be putting $1,000 aside for the roof, per year. Same thing with HVAC units, windows. So you can get as granular with that as you want. But I would say, a safe reserve per year, about $2,000 more if you feel like you have older systems that are coming up. So that gives us our total expenses for the property based on the total income. As you can see, it doesn't give you a lot of room there based on your expenses versus your income. If I had an actual property I was running this on, it'd probably be a little bit more accurate. But I want to show you the difference between the beginning and the end stage here. So total net operating income is $14,144. If you take that valuation, that NOI, and you use a cap rate to try and find the value, a lot of places around us are at a 7% cap rate. You really need to see what the cap rate is for your area and the property class type that you have. The more deferred maintenance and the more maintenance that a property probably needs, the higher the cap rate will be. Vice versa, if it's a lower cap rate, that means there's less risk involved. Probably has a lot more updates, probably a lot less maintenance and a lot less tenant issues. So based on the current valuation, with a cap rate of 7, this property is only worth $200,000. We know that a property isn't going to sell for that, but when you're looking at it from an investor's perspective, if it's only making 14,000 a year, this is what you can justify to pay in cash to make a 7% return on the property. So keep that in mind. I don't know what a normal loan right here would be, but if you have a loan payment, this is where some other terms come in here. If you have a loan payment, let's just say your loan is, let's say 4,000 a month for a 6 unit, and let's say 2,800 a month. So that gives us a $33,000 yearly bill. So down here, you'll see annual debt service, 33,600. Your NOI is 14,000. So, if you're in some pain right now, I totally get it. I've had plenty of clients. I've been in this situation before that the debt service really is causing a negative balance, a negative cash flow position on the property. So if you're losing money every year, you need to know that, and you need to plug all your numbers into this as realistically as possible to be able to see what your current situation is. This debt service coverage ratio. So just to break this down, annual debt service, just what you pay in debt. NOIs or net operating income. Obviously, that's what's left over after expenses before the debt service. And then what the banks really look at is this debt service coverage ratio. So they take your net operating income and they divide it by your annual debt service. And that tells them how much money you have as a buffer in order to pay your mortgage payments. So the banks typically want to see about a 1.25 plus debt service coverage ratio. That means for every dollar that's going out towards your debt, you're bringing in $1.25. So you've got a 25% buffer after your expenses are paid in order to pay your debt back. So that's where the banks like to see it if you're doing a refinance or if you're trying to purchase a property or something along those lines. So our goal should be to get this debt service ratio back to 1.2, 1.25 or higher. Okay. So this is a little bit of a bleak situation. Obviously, I'm throwing a scenario out there, but I want to show you what this looks like after an action plan is put in place, because this is really where the money's made. This is where we love to step in and completely transform someone's life with an asset like this. So let's go over to the stabilized calculator. We're going to copy and paste some values over here. So after the action plan has taken place, we have put some money into the property. Maybe you've hired us to come in and use our construction services to do the renovations. Our management company comes in and we get the empty leases pulled back out, or the empty units filled. And over the next 12 to 16 months, we are raising rents, doing upgrades, and really getting these units back to market rent. So let's say we get everybody to 1250. You can see how much that adds almost $40,000 worth of income right there, just without the vacancies. Um, Come back down here to expenses. I'm going to copy and paste what we had from here down. So let's say accounting probably going to stay the same. Insurance most likely will stay the same. Your taxes, good luck trying to get those down. It's probably not going to happen. But let's say repairs and maintenance go down pretty drastically because we've put some funds into the units and upgraded them. But hey, stuff still breaks, so we got to have something there. Trash services, probably can't pass that off. Depends on the situation, but a lot of times, a dumpster is kind of the responsibility of the owner. However, electric, if we weren't paying that, let's say we just had common area electric for the year, say it drops that down to $1,800. Water sewer, you can do some sort of bill back. We've done percentages on our properties before where tenants are responsible for X percent of the water sewer usage just because of the square footage or based on the square footage of their property. So let's say we get this down to zero, we're getting billed back for that. And then capital expenditure reserves, probably going to keep those the same unless we put new roofs on, unless we updated HVAC. Some of the major systems got done in that action plan part of it, then that's where we kind of factor that stuff into the equation. So we've lowered some expenses. Total expenses now about 33,000. The net operating income, let me double check that. Yeah, so we've lowered the expenses some, but the biggest difference came in, upping the vacancies or upping the occupancy, upping the rents, and making the leases more efficient. The other thing that you can do when you're looking at value add or ways to make more money, like we mentioned, the parking. So let's say, we were able to charge a little bit for parking. Say we were charging about $50. We've got some garages or some storage units or something. I'm making this stuff up as I go, but I want you to see what the possibilities are. Let's say we're pulling in an extra $350 a month for parking. We've got some storage units. Let's say a storage unit per. So we got $50, 50, 100, 150, 200, 250, $300 a month for extra storage. So that gives us 7,800 in extra income. So now when we go down and we look at our net operating income, that looks a lot better than the 14,000. And this is 100% possible. We've done it for clients where we've added, they were losing $100,000 a year. We went in and did this action plan and made it to where they were making 100,000 plus a year in NOI, and it raised their valuation by $2 million or more. So when we look at this NOI and we use the same cap rate as we did before, we went from a $200,000 valuation to a $900,000 valuation, which is pretty darn good. So let's look now at what did we say our debt was? Kind of made this number up, but let's say we kept the debt the same, and we're going to plug these numbers in here and go back and look at our coverage ratio. So dang, yeah, that makes a huge difference. So we went from losing money every year to now we're making about $30,000. We've got a 1.88 debt service coverage ratio, and that really is the beauty of knowing your numbers, looking at what levers you might be able to pull with these value add calculators, and really maximizing the value of an asset. I can't tell you how many times I've talked to an owner and they thought their property was worth this number just because of other properties that have sold around. But when you really dig into the numbers and the operations, it's worth closer to this number or nothing. Nobody's willing to pay enough to lose money on a transaction unless they're coming in and doing the project themselves. So hopefully this will help you. If you do need help with the calculator or you want us to come in and do an audit for you, that is literally what we do. So feel free to reach out to me again. It's Cody, CODY at havenpm.us, or you can call me at 540-599-7480. We'd love to sit down with you, go through your property, go through the books. We provide a full 2-week audit on site if that's something that you want to pursue. We'll come in and we'll look at all your leases. We'll walk every unit. We'll look at all the expenses, all the invoices that you have to take care of. And then we'll identify for you what some of these value add levers can be. They're going to be different for each property. So feel free to reach out. Would love to have that conversation with you. And at the end of the day, we are a service platform. So if you need a plan like this executed, that's our bread and butter. So please reach out. Would love to hear from you, and good luck.